Today, I want to talk about not just one, but $3 trillion banks that have maxed out their risky lending to hedge funds and are about to collapse. So stay tuned and let's make some money. Before I dive into the video, remember the Labor Day sale at the Millionaire Mindset Trading Group is now on. Just use code LABORDAY, all in capitals and all as one word at checkout for $100 off the price of the lifetime membership or 25% off the monthly membership. So let's dive straight in with the key information. So, Bigums has tweeted saying, now is the time for me to show you that he was right for the last 3 years, and has explained how retail investors will win. So we can see this article says that 3 megabanks had loans outstanding of $1.832 trillion to giant hedge funds on March 31st. Now, the article doesn't say what the largest borrowing hedge fund is or the largest amount borrowed by a single hedge fund, but it could be easily in the tens, if not hundreds of billions of dollars. And obviously, if one of these hedge funds were to collapse, it creates a massive domino effect on not just one of these banks, but potentially all of these banks, as they have to recall loans to reshuffle their risk portfolios. Now, so this is the article. So first, let's go through this chart in a little bit more detail and explain what it's actually showing. So we can see from this chart here, banks have given multiple $1 trillion in loans to these hedge funds, and these hedge funds have maxed out their borrowing and maxed out their leverage ratios and likely cannot afford to repay the loans. We can see there's 3 individual banks here that have lent over $500 billion each to risky, maxed out leveraged hedge funds. Now, the article says particularly alarming is that US megabanks are receiving federal deposit insurance, which is backstopped by hardworking and law-abiding US taxpayers. And these banks are using their lending ability to make massive loans to dodgy giant hedge funds that are regularly found out to be on the wrong side of the law and or engaging in wildly risky behavior. So these banks are effectively using money that's backstopped by the taxpayer and lending that money to lend it to risky and illegal hedge funds. And equally concerning is whether megabanks lending to giant hedge funds is actually sapping their ability to make actual loans to worthy US businesses. The article then goes on to talk about Credit Suisse, who lost $5.5 billion in the Archegos collapse. And it begs the question, what would happen to any of these major banks if a slightly larger hedge fund were to go under? There's likely hedge funds out there borrowing not just $5 billion, but $10, $15, $20, $50, maybe even $100 billion, which could really cause many of these major banks to collapse. And if even one of these banks were to lose a large sum of money, it creates a domino effect as these banks try to recall loans from other hedge funds to balance out their risk portfolios. And speaking of which, Kristen has also tweeted saying that Citigroup, the parent company of Citibank, reported $104 billion in securities sold, not yet purchased, for the period ended June 30th, 2024. So gone are the days of these hedge funds and banks seeing maybe 10, 20, 30 or 50 billion in securities sold, not yet purchased. Now that figure is looking like over $100 billion. Again, across the industry, across these hedge funds and across these banks, this figure just seems to continue spiraling away. So we can easily see that when a forced closure of shorts is enforced, this could easily wreak havoc not just on 1 or 2 hedge funds, but even some of the largest mega banks. And speaking of which, in an attempt to offload that risk profile, JPMorgan now plans to offload credit risk from a $531 million adjustable rate mortgage portfolio through a new strategy called deconsolidated portfolio risk transfers. So JPMorgan is going to identify risky assets, transfer those mortgages of those risky assets off of their balance sheet, and then sell bonds to investors, likely unsuspecting investors, shifting that risk. And said that Reuters describes this as banks escaping regulation through synthetic risk transfers, a strategy reminiscent of pre-2008 financial engineering. What could possibly go wrong? Now, so the reason why JPMorgan is trying to shift this risk is because at the moment they don't meet the new capital requirements. Therefore, they're trying to shift risk and shift capital off balance sheet elsewhere to unsuspecting investors so they can continue meeting capital requirements and not get margin called. But again, really, this is just a temporary fix for a much larger problem. The liabilities still exist and the liabilities still have to be paid, and these debts could still end up going bad and people could likely default on those mortgages. Especially because I imagine a large portion of these mortgages are going to be commercial real estate mortgages, which are already going bad already. Again, it's just another temporary measure to kick the can down the road and avoid imminent margin calls. And as I said, if some of these top 3 banks are already failing to meet margin requirements, what's going to happen when they start trying to recall these loans, destroying the hedge fund industry? Also, guys, I wanted to go through today's 98% gainer in the Millionaire Mindset Trading Group on WHLR. This was actually just one of 3 trades we took today, and all 3 were profitable trades. As we can see, Zach scored a quick 15% on WHLR, a small 5% on APLD, which left him 3 for 3 today, including the pre-market trade on EAST. A few others in the group also scored on East, APLD or WHLR, with Ducat making as much money as he does from a full day in his 9-to-5 job in just one quick trade. So guys, be sure to join the Millionaire Mindset Trading Group using the link in the description below and using code Labor Day, all one word, all in capitals at checkout for $100 off the price of the lifetime membership or 25% off the monthly membership. Now, I also wanted to go through this new tweet from Adam Aaron talking about City of Dreams. I don't specifically want to talk about the film, more this second part of the tweet where he said that similar horse manure conspiracy theories circulated last year about AMC and the movie Sound of Freedom. And he said, in my view, the best theories as to why this happens is because either short sellers and or others want to trash AMC because they wish us harm and have a vested interest in trying to hurt us, even if nefariously so. And he said, or some people out there aren't playing with 52 cards in their deck and are basically stupid, or importantly, both. He's saying he knows that short sellers are out there wishing harm to AMC, but that those short sellers are stupid. And he's also said those short sellers are trying to harm AMC in a nefarious way. But again, those short sellers just simply aren't playing with 52 cards in their deck. I love to see Adam Aaron fighting back against these short sellers because he knows the shorts are in the wrong, he knows that AMC is profitable, and he knows that these short sellers will end up being liquidated if they continue shorting. And Giovanni has pointed out that actually many hedge funds out there, not the short selling hedge funds, but the other ones, have actually seen that AMC is improving and will liquidate shorts. And that's why the AMC bonds are increasing in value, because the lien holders are willing to pay more for AMC bonds due to the ever increasing unlikelihood of bankruptcy. Basically, many hedge funds and lien holders of AMC's debt out there know that AMC won't go bankrupt, and therefore they're paying more and more for those AMC bonds, increasing the price and increasing the value. And speaking of which, the Q3 box office at the start of September has now hit over $2 billion. It's very likely by the end of Q3, the box office will have hit $3 billion, a new all-time high. Especially with Beetlejuice and a new Transformers film, it could easily hit over $3 billion at the Q3 box office, being AMC's largest and most profitable quarter ever. And finally for today, Citadel has now been named in a RICO lawsuit in Georgia from September 1st, 2024. So the article says that Citadel is now named in a RICO lawsuit in Georgia, along with others, for defamation and intellectual property theft. Now, this lawsuit doesn't specifically deal with naked short selling, but I don't think it'll be long until Citadel is dragged into even more RICO lawsuits. So guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers.